Hey everybody, welcome back. Last time I made a video, I was talking about the S&P 500 reaching its 200-day moving average, and since that video, it looks like the S&P was rejected off of its 200-day moving average, moved a little bit lower, and now it's trending upward once again. So, due to another cooling CPI report, pretty much all the indices have been moving up again. And now we're going to take a look at the SPY. And the SPY once again has reached its 200-day moving average. So today you can see this this candle here pretty much finished with a doji candle, which indicates indecision in the market. So it will be interesting to see if the S&P 500 can hold its upward momentum. Looking at the RSI, it's got a little bit of room to go higher, and the MACD has crossed over, going upward. So RSI above 50, MACD moving upward. So it is bullish, but doesn't have a ton of room. And if you look back at the previous year, 2022, it was pretty much in a downtrend all year and moving within this channel here. So it'll be interesting to see. I'm assuming it's probably going to have another leg down. February 1st will be the next Fed rate increase. Everybody's expecting 25 basis points, a quarter of a percent. So that'll be positive for the market. It's expected, but I think this next leg down is most likely going to have to do with an earnings recession. So the banks, I believe Friday, the banks start to report earnings from Q4 of 2022. And we might see the start of the next leg down there, but obviously only time will tell. So that's the quick analysis for the S&P. It's currently hitting that trend line, and it's also currently closed above its 200-day move average. So we'll see what happens with that. So moving on, looking at the QQQ, pretty much the same deal. However, the only difference with QQQ is it's well below its 200-day moving average. Obviously, tech has been getting beat up pretty hard, especially because of the rate hikes. And as of, let's zoom in here a little bit, right around the 14th of October, QQQ has pretty much been moving sideways. So you can see on the 13th, it sort of dipped down here, retested this trend line here, retested again, moved up, and then retested once again in late December, and it's been on an uptrend, actually a pretty strong uptrend, but only since the start of the year, pretty much. So QQQ will probably be the first one to have big declines in this next leg down. I am assuming that it's going to come in contact with this trend line and then probably start its next leg down. I think maybe Friday, if I had to guess. Friday will be start of earnings from Q4 of 2022. So that could be the start of the next leg down. But I don't really see it going much higher. If you look at the RSI, it's bullish. MACD's bullish. But as far as the RSI goes, it's pretty much reaching the range that it reached last time back in late November, before it moved downward and then came back up. So that's a look at the QQQ. The Dow Jones, more similar to the S&P 500 as far as its strength. So it has managed to stay above its 200-day move average, which is pretty cool. I don't know how long that'll last, but it's definitely doing the best out of the 3 as far as over the past year goes. Let's see here. Yes, it's definitely doing the best. I mean, it's only negative 2.6% over the last year. If you look at QQQ, it is negative 25%. Let me make sure I'm on the right scales. About negative 27%, whereas the S&P 500 is about negative 14. So Dow Jones is doing the best. And typically that's what's going to happen in a downward trending market. Is the Dow Jones is not usually going to drop as fast or as violently as the S&P or the QQQ. However, I think once you head into a recession, pretty much all three of them drop just about at the same rate. I think when it's all said and done, I mean, they usually have about depending on what you're looking at, they usually all have around the same decline. Trying to go back to 2008 here just to get a rough idea. Let's see. So from the top to the bottom, the S&P 500 fell about 55%. Let's look at the NASDAQ. So the NASDAQ fell roughly about 53%, and the Dow Jones, I'm looking at the 2008 recession. So Dow Jones fell roughly, about 51%. So they all pretty much have the same declines, peak to trough when you go into a recession, at least for 2008, which was a pretty bad one. One other thing I wanted to look at real quick is TLT. So TLT is the 20 plus year treasury bond. And what's interesting about TLT is while it is in a downtrend because due to the rate hikes, you can see it's sort of bouncing off these trend lines, and it's almost coming to a head. So it'll be interesting to see what happens with TLT. Generally, TLT trends upward in a bear market as stocks are moving down. However, when the Fed is hiking interest rates, typically the bonds, especially the long-term bonds, will start to decline, like TLT, and you can see that kind of play out through all of 2022, 2021 a little bit, but the Fed started hiking rates in 2022, and you can see this sort of sharp decline in TLT. TMF, obviously the same deal. This is a 3x leveraged version of TLT. It's got the same trend. So if you notice trends like these where bonds like this are starting to take downward moves, you can what's nice about these is you can play the inverse moves on them. This is TMV, 20-year treasury, inverse of TMF. So you can see this one pretty much was moving up all year long in 2022. Let's see how much of a rise it got from the bottom to the top. Had about a 215% increase. So, and the way you can kind of spot these is I just use the moving averages. So this is a golden cross. This would be considered a golden cross here. The 50-day moving average, which is the green line, crosses above the 200-day moving average, is the black line. That's considered a golden cross and typically signals a start of a bull run. For TMV, this would have been the start of a bull run for this one. So it will be interesting to see. You could see it kind of curved over, dipped, and then went up again. I wonder if it'll do the same thing. Looks like it's having a more dramatic downward turn this way, but I wonder if it'll sort of get close to the 200-day and then kind of curl upward and start moving up again. Theoretically, it should, because the Fed is still hiking rates. It just depends on how much of that has already been priced in to the movement in the treasuries. So that'll be interesting. Let's see. What else did I want to hit? I think that's really about it. Something else you could do too is take a look at XLP. I've talked about this in previous videos, but this is another sector of the market, consumer staples. So typically consumer staples do relatively well in a downward trending market or a bear market, only because as companies, tech companies, maybe consumer discretionary spending, things of that nature, as those start to take earnings hits because the average person out there might they're pulling back on their spending. They're cutting back on luxury items, things that they don't necessarily have to spend money on. But they're still going to be spending money on quote unquote staples. So, toilet paper, shampoo, conditioner, body wash, things that you would buy sort of in your everyday grocery store aisle. That's what XLP is more going to be geared towards. And as you could see here in the past year, it's pretty much flat. It's not even negative 1%, whereas you compare it to the stock market, it's definitely outperformed. So obviously it has its ups and its downs. But if you're heading into an overall longer term downward trend, you could transition to something like consumer staples. And let's say if you're wanting to exit equities, normal stock market plays, you could get into this. Would be considered a more defensive position, and you're not going to lose nearly as much money. Let's see here. Okay, so just to show you what I mean, I'm going to compare the two. So I'm going to compare XLP to the S&P 500. So let's do a look back at the last year. So this green line is XLP, and the pink is the SPY. So you can see over the last year, XLP, like I said, it's just about flat, whereas the S&P 500 is negative 15%. And then also if you plug in, let's just go QQQ, and then also the Dow Jones. You can compare the three sort of side by side. You can see that consumer staples has outperformed all three, even the Dow Jones, which is pretty close. But again, the Dow Jones is more of the industrial sector of the economy. So that one tends to decline the least, at least at the outset. But once you do hit that hard recession, pretty much the entire economy is going to take a hit. And you'll see that XLP will take the least damage. And you can actually go back here and see what that would have looked like. So I'm just going to go back to January 2008, and I'll run the test through, let's just say 2013, beginning of 2013. So as you can see here, so 2008, when the recession, when the market really started to take a dive, XLP really was not hit nearly as hard as the S&P, the QQQ and the Dow, the NASDAQ and the Dow, I should say. So, and then you could kind of see that, because it didn't dip down as much, it also went back up with the rest of the market, and it stayed above the rest of the market for quite a while, right around to, pretty much really all the way through the recession. And then obviously the longer you play this out, the more time that the rest of the stock market has to catch up with consumer staples. So in a bull market, consumer staples is still going to go up. It's just not going to go up as dramatically or as quickly. It's going to be a lot more stable. And you can see that play out down here. If you look, so this is XLP, so about a 10.4% annual rate of return with a 32% max drawdown. This is that 2008 crash. S&P 500, 51% decline with a 6.6% annual return. Again, this is 2008 through 2015. I'm sorry. Yeah, beginning of 2016. So NASDAQ, 49% drop. Dow Jones, 48% drop. NASDAQ had 11.5% rate of return. So XLP through the same time period actually outperformed the S&P, and the Dow Jones actually kept pace with the NASDAQ pretty well. So pretty impressive for an ETF that is sort of a lot more of a defensive position. But as like I said, as time goes on, we'll just go to the end of 2021 right here, since this is the bull market lasted until about the end of 2021. See where XLP ended up. So you can see the NASDAQ obviously outperforms because all the tech stocks and everything. XLP ended up in last place. So that's to be expected because it's a defensive position, but either way, it typically does well, and then it doesn't fall nearly as much in a bear market. One other one I like, I think I've talked about it before, is SPHD. This one you cannot test through 2008, so it's hard to tell what it would have done through 2008. I believe this one starts in about 2012. Oh, a little bit more. Let's just go to April. All right, so from 2012 to 2021, same thing, underperformed. If you go down here, what's interesting is XLP actually took a bigger hit during COVID than any of the other indices, which was interesting. It was quick, but it had a sharp decline. But still recovered. But oh, I'm sorry, that's not XLP. I apologize. SPHD is what I meant. So SPHD is an S&P 500 high dividend, low volatility ETF. So it's going to mirror the S&P 500, but it's going to be allocated to more high dividend paying companies. And then obviously it's focused on a lower volatility as well. But that's another defensive ETF that you can use in place of XLP, or you can use it alongside XLP. So if you look at the last year, SPHD has also outperformed the three other indices because it's focused on high dividends and low volatility, and that's exactly what you get. So you can see the max drawdown here is only 19%, just about the same as the Dow Jones. However, the return has been better. So that's another defensive position you can take if you're in a prolonged down period in the market. So yeah, that's about all I got for this video. I hope you guys enjoyed it. I want to see what happens in the next couple of weeks. Obviously, if something big happens soon, I'll make a video on it. But I just wanted to kind of cover mainly the S&P hitting that trend line, also closing above the 200-day moving average, especially with a potential earnings recession coming up, and then also more Fed rate hikes. If the Fed surprises to the upside and raises rates a 0.5%, and the market's expecting 0.25%, we're probably going to see a big decline. But I don't see that happening. But obviously, you never know. But is interesting to see that 50-day getting closer to that 200-day. That would be considered a golden cross if it does cross over. But doesn't mean it's going to last. I mean, you could get faked out, but only time will tell. So yeah, hope you guys enjoyed, and I'll see you on the next one.